actually sitting here since 5 o'clock, since 5 to 5, the parking lot. So, and it's a nice campus. Reminded me when, this is a 4-year university? 2 years. Okay, I don't know if you guys know about Hartnell College, that's up in Salinas. I went there a long, long time ago. But anyway, who's in sports here? Okay, good. Just a little bit of sports trivia. Did you know that the NBA just finally awarded their first international franchise? And the LA Clippers won. Yeah, they're going to be moving to the Philippines. And they're going to be called Manila Folders. Yeah. Can you imagine from LA Clippers to Manila Folders? He got that one. Anyway, does anybody know anything about financing at all? When you want to buy a house, of course, you can either buy it cash or you can get a loan. Most people get a loan simply because it's hard to come up with $500,000, $400,000. But there are certain guidelines that the lenders look for when it comes to financing. Firstly, what I'd like to kind of let you know is there, why would people want to buy a house anyway? Is there a specific advantage to owning a home? Cheaper than rent?
In the long term.
Maybe. Yeah, the tax benefits is good. Pride and ownership, of course. It's a lot nicer to say, hey, let's do barbecue at my house instead of, let's do barbecue in my apartment. Yeah. Still still my house, you know, my place. And the pride of ownership is there for certainty. And then, of course, investment. You're paying your rent. Who does that go to? The owner of the property that you're actually renting. And if you own a home, you build equity. And of course, I just closed a deal for a single mom. That was back in January of 2015. She bought the house for $459,000 in Long Beach. She put in 3.5% down on an FHA loan. Now the property is worth a little over $600,000 in just about a year and a half. So certainly there's equity there. You know, it's not, there is a definite advantage to owning a home. What is the disadvantage though? Exactly, the upkeep. If you're renting and let's say the sprinkler or whatever, the air conditioning broke down, who do you call? The landlord. If something happens to your own home, what do? You go to Home Depot and, you know, buy whatever you need to do in order to get it fixed. But certainly the advantages outweighs the disadvantages. Okay, so here's the situation though. We look at three things when we qualify somebody for a home loan. Okay. Income, credit, cash to close. Or actually they call it the 3 C's or the 4 C's. I'm gonna let you know what the other C's are. We don't have a chalk or a whiteboard here. Do you? It's okay, so, you know, I'll see if I can speak as clearly as possible so you guys can visualize what I'm saying. Okay, there is what you call the 4 C's, the letter C. Number 1 is for capacity. Capacity dash income. That's your capacity to make the payment. So you have to have a what? A job, very good, in order for you to be able to pay back what you owe. And then the second C is credit. You have to have at least a decent credit. Now, you don't have to have a stellar credit. We talk about, you know, how credit actually relates to your interest rate, how much you buy, what kind of loan, what kind of program that you can get. You have to have at least decent credit. That's the second C. But the thing is, if you have a job and if you're paying your bills on time, you should have what? At least good credit or excellent credit. I like the double-breasted test. Yeah. Thank you. So anyway, and the third one is C for cash. What do you use cash for? For down payment and or closing costs. It's just like when you buy a car, you need to have a down payment, and then of course you have to have your your licenses, your taxes. Those kind of things are closing costs, and there are recurring and non-recurring closing costs. When you say recurring closing costs, it occurs more than once. What are the two things that occurs more than once when it comes to owning a home? Property tax and homeowner's insurance. Okay, so those things. What are some of the non-recurring, because it's a one-time deal? Well, you have to have escrow. We only use that, of course, when we actually have a transaction. We have title insurance, meaning to say that the title of that particular property has to be cleared so that when you actually take over the property, nobody else is on title. And there is a title insurance to make sure that title is clear. What else? Appraisal. If you are selling your home and I'm buying it, and you're selling it to me for, let's say, $350,000, I want to make sure that I'm getting $350,000 worth of property. And how do you do that? We order an appraisal. It's a valuation of the property, depending on the market, the type of property, whether it's a 2-3 bedroom home, the location, and whether it's a single family residence, whether it's a condo, those kind of things, okay? So that's part of the closing cost, which is the appraisal. And there are other, a credit report fee, loan tie-in fee, the notary, because when you sign loan documents, a notary public has to, of course, witness your signature. So there are a lot of those things involved in the closing cost. So how many C's do we have right now?
3.
What are those?
Credit,
Cash, okay. Now, as far as cash is concerned, let me go back then. Let me just finish the 4 C's. The last C represents collateral. The collateral is the property itself, okay? Because you're buying a house, you're applying for a loan, the loan has to be collateralized. Meaning to say, the bank is giving you $400,000, how are you going to give it back? The $400,000. It's not going to be based on your signature. There has to be a collateral. Meaning to say that that particular $400,000, there has to be some sort of something to make sure that if you don't pay, we get that back. And that collateral is the what? The property itself. Okay? Any questions so far? What's your name?
I'm Elizabeth.
Elizabeth, I like that. With Elizabeth. This gentleman here? Luis, oh, you're Luis, yeah. Who's the other guy? Michael. Yeah, I was staying there in front of the student services building for a while. So they got me. Thank you. Senor? Samuel? Okay. You know that that's a biblical name, right? Who was he? Ronnie? Oh, I have a brother's name is Ronnie. Anyway, so we have those 4. Capacity or income, credit, cash to close, and collateral. At least the 3 things when we pre-approve someone, we forget about the collateral first, because we have to have those 3 first. The income, credit, and cash to close in order for you to get pre-approved for financing for a loan. Because once you have those three in place, then we can go out there and get the collateral or buy a house. Will it be better for you to go shopping with money in your pocket or without money in your pocket? Of course, with money in your pocket. So what I do for a living, basically I ask people when they want to buy a house, how ready are you really to buy a house? On two fronts, 10 being ready and one not quite ready. When I say on two fronts, because on one front, emotional readiness, how ready are you? And the second front is financial readiness. The fact that we are talking like this, when I tell them, you decide to buy a house, you're expressing to me, your emotional readiness might be up there, or must be up there, maybe 8 or 9 or even a 10. But the thing is, your financial readiness may still be down here. So my job is to bring that emotional readiness or the financial readiness on the same level. So that when those two meet, then I can get you pre-approved, put money in your pocket, so that you can go out there and look for a home based on your qualification, based on your income, based on your credit, and whatever cash that you need to come up with. Okay? So, three things: income, credit, and cash to close. As far as income is concerned, and I'm gonna get a little technical now here, okay? So, if I lose you, just raise your hand and I can ask you a question. There is what you call a certain DTI. Those are D-T-I. It stands for debt, D-E-B-T, to income ratio. And you know what those are, right? It's the amount of debt you have against your income. As far as the lender is concerned, the rule of thumb is we go by 45% debt to income ratio. So if I'm just gonna throw in a number there, just to make it easier. Let's say $1,000 is your monthly income. What is 45% of $1,000? Gosh, this is a college, right? $450.
I knew it's $450.
There you go. Thank you, sir. So, means to say that $450, and okay, let's just say I'm gonna use $10,000, so to make it easier. So $4,500, that's what we can use for your maximum debt to income ratio. Means to say your housing and all your debts cannot exceed 45% of your income, or $4,500 in this particular example. So if our example is your monthly income is $10,000, our DTI, or our debt to income ratio, that's the guideline, is 45%, means to say that you cannot have more than 45% or $4,500 combined between your monthly obligations and your housing expense. Now let's break down the monthly obligation. We will only look at what you pay based on your revolving and installment accounts. Okay? We don't look at your cell phone bills, utility bills, just revolving and installment accounts. When you say revolving, what do they mean? What is a revolving account? Yeah, credit cards usually, because you can use it over and over, and then you just pay it and then it revolves. An installment account, basically, it's just like a car payment. You owe $15,000, you have a monthly payment. Once it's paid off, it's gone, it's done. So there is a beginning and there is a start as far as your installment account is concerned. Your student loans, for those of you who have student loans, that is an installment account. But any type of credit cards, whether it's from Macy's or Sears or it's a Visa, MasterCard, it's a revolving account. And we only look at the minimum payment on those revolving accounts. So we looked at, let's say, the combined total of all your revolving and installment accounts, and we came up with, let's say, $1,500. Now, in our example, we have $10,000 of income, right? But how much of that can we actually just use, or based on our qualification? The 45%, which is, what's 45% again of 10,000? 4,500. I know, I tricked you there earlier, this is $1,000. So we have $10,000 in income. We have $4,500 that we can use maximum between our housing and our total bills. Now, we determined though that our bills is about $1,500 per month between your car payment, your credit cards, your student loans, $1,500. So how much do we have left? You take $1,500 from the $4,500, how much do you have left? $3,000. That's the amount right now that we can use for your housing. So the question is, how much house can we buy with a $3,000 monthly payment? Whatever that amount is, then that's the maximum qualification that you can get. Let's just say that amount is, let's say, $500,000 or $480,000. So, you need that. Anyway, so that's basically the $3,000 though, that's what you call, you probably heard the term PITI. Peter, Iota, Tom, Iota. PITI stands for principal, interest, taxes, and insurance. So your mortgage payment actually includes all those. Whatever you pay for your principal and interest basically is based on your loan amount and whatever interest rate you're getting. And then whatever the taxes are based on the county, typically here in Southern California. Your property tax is based on the 1.25% of the total value or the sales price of the property. That's your annual. So you take that annual and then divide it by 12, that's your monthly property tax. Your property tax are due twice a year, typically in November and in April. Okay? Your insurance, of course, it's due every year. It's just like when you buy a car, you have car insurance. You also have to have what? Homeowner's insurance when you buy a home. For what reason? Exactly, pretty much for fire, any kind of hazard, or somebody got hurt, liability in your place, then you get that. Okay, so I'm going to go through some of these as far as the credit is concerned, so you know exactly where we're at. Any questions so far? Yes, go ahead.
What would you say is the okay credit score?
Okay credit score for most lenders, for most products or programs, 640, especially with FHA, is the minimum. However, Wells Fargo has a proprietary program called Your First Mortgage, and we can go all the way down to 620 FICO score. Now, that's the credit. We talk about the income, which is the capacity. We talk about the 45% debt to income ratio, okay? Now let's talk about the cash to close. What are basically the good sources or acceptable sources of cash for down payment and closing costs? It can be your savings, it can be your 401k, and it can be actually some down payment assistance. There are housing agencies out there, there are nonprofit organizations that actually provides down payment assistance to those who want to buy a house, okay? So, now let's go then with, okay, thank you very much. Now, we talk about the capacity, we talk about the collateral, we talk about the income a little bit, the DTI. Now, let's talk about the credit, because that's where most people have some, or quite a bit of questions. Let me just go, I'm gonna go over this a little bit though. We talked about earlier about your debt to income ratio as far as what we consider is basically your taxes. I mean, basically your income, your revolving and installment accounts. And it's based on gross income. The reason why we go by only 45% of your gross monthly income is because also you have other expenses, such as your groceries, children, daycare, clothing, shoes, transportation, and other things. And so what people sometimes say, how come we only go by 45% of the gross monthly income? It's because of those things. Cable, phone. I know somebody who's actually spending on internet, cable, and phone over $300. I certainly don't know why, but And there we are. Do I have enough income? Do I have the source of income to make a monthly payment? Do I pay my bills on time? That goes through credit. What's my credit history, credit score? Do I have a lot of other outstanding debts? Do I have enough funds for a down payment? And again, this is where most people have some challenges with, as far as down payment is concerned. But there are programs that require you to only come up with 3 to 3.5% down payment. Okay, you don't have to have 20% down payment in order to get into a home. 3% will actually make it. Okay? And then of course, then you have to have the closing costs, but most closing costs can either financed or we can have the seller for that. We can actually have them negotiate for them to pay for that. And what is the market value of the property? We talked about the collateral earlier. We have to have an appraisal in order to do that. This is the relationship between down payment and the principal amount. Of course, if you have a bigger down payment, your loan is lower, and therefore your payment is also lower, which means that you can qualify for a little bit more home. However, like what most people nowadays do, because they don't have that much down payment, they only put 3% down, and they can only qualify for whatever the maximum their income can qualify them with a 3% down payment. I'm just going to go through this real quick. How do you save for a down payment? Now let me ask you this, guys. Who among us has a budget? Here. Good. Okay. The rest, I guess, they either don't or don't care. But that's okay. When you have a big responsibility, like buying a home, you must have a budget. And there are basically 2 or 3 kinds of budgets. The one is that your fixed budget. What is that? Your car payment, your credit cards, your rent, your utilities. And there are those that kind of just sneak up on you, like car repairs. If you have kids, well, some of us who do, a lot of things can happen and say, Dad, I want this, I want that, or the school, they need it, they need this. those are unplanned expenses. So you need to kind of be prepared for that as well. That's why, creating a spending plan is very necessary. Now, what if you don't have a lot of money for a down payment? We saw that. Who among you are veterans around here? Oh, fantastic. The veteran or the Veterans Administration actually allows a veteran to come in with pretty much no down payment, and usually their interest rate is lower. And as far as Wells Fargo is concerned, we waive all the closing fees for veterans. Yeah. Now, there is what you call a funding fee for veterans. And that's how the government makes their money. Because let's say if you have a loan or a house that you want to buy, let's say it's $300,000 home, the funding fee is approximately 2%. How much is 2% of 300,000? That's $6,000, right? So it gets added to the loan amount. So instead of having 100% financing of 300,000, now your loan is up to about $306,000. However, you can actually just increase the rate a little bit so that the lender can pay or eliminate that funding fee. And there are also down payment assistance programs that will pay for that funding fee for the veteran. So in order, the best possible financing out there actually is a VA loan. The thing is, not everybody is a veteran, therefore this is a special program for those veterans who actually sacrifice to, put their life on the line to protect us. Go ahead.
And the VA loan, it applies to any veteran?
Mm-hmm.
Because the credit is kind of shaky, or?
No, you need a good credit score also.
You need, yeah. When it comes to the capacity and credit, it still applies. But as far as the actual program is concerned, they have a special type of program for that. Now, let me just kind of talk to you about this pre-qualification versus pre-approval. Basically, a pre-qualification is when somebody asks you to get me pre-qualified. It's just an opinion from either the loan officer or the mortgage consultant. A pre-approval, however, that's when we actually check your income, we check your credit, and we determine what kind of closing costs or cash to close you have, and then we run it through a certain underwriting system, and then you get a pre-approval. It means to say it has gone through some sort of an underwriting procedure. And it carries a lot more weight than a pre-qualification, because a pre-qualification is basically just an opinion. So if you are really serious about buying a home, get yourself a pre-approval rather than a pre-qualification. Okay. Any questions so far?
I want to ask a question as far as the VA loan.
Yes.
So their children wouldn't get a discount on the loan, would they? If their children, your father was a veteran?
Oh, it's just the veteran themselves, yeah. But the wife can be on the loan, of course, but if you're a spouse of a veteran, and the veteran perhaps passed away because of service-related injury, then you can take over the eligibility.
Okay.
And these are just a benefit of pre-approval. So. I'm just gonna go through this real quick. There are two types of loan. Basically, it's a conventional loan. It follows Fannie Mae and Freddie Mac guideline. Fannie Mae is the Federal National Mortgage Association. Freddie Mac is what you call the Federal Home Loan Mortgage Corporation. Those are two semi-private entities who buy loans. So the way it works is this. Let's say this is a bank. We're a bank. We lend out money to people, to the consumers. Okay, so we pool those loans. Let's say we have now $100 million worth of residential loans. we sell it to either Fannie Mae or Freddie Mac. Then we get back our money, they service the loans, then we got the money back, and so we can sell it again, we can loan it again to people. And that's what they call the secondary market. We are the primary market because we primarily actually deal with the consumer. Make sense? The same thing with FHA. The only thing, the difference between FHA or government and conventional, your government loans are your FHA and VA loans because they guarantee the loan. Simply because VA does not require any down payment and FHA only requires 3.5%, it's a very risky loan for the lender. The reason being is if something happens or times get tough, most people will just walk away. And then the lender ends up holding the loan or the property. And it's a lot more costly to foreclose on a property than actually servicing it and receiving payments. Okay? So, that's where we're at. There's also what you call a fixed rate mortgage, and there's also an adjustable rate mortgage. Fixed rate mortgage, basically it's amortized for a period of time. You pay it within that period of time and you're done. The terms can be from 30, it can be also anywhere between 10 and 30 years. So if you have a 30-year mortgage, you amortize it for 30 years, your payment will be based on a 30-year payment. So how many payments are there in 30 years? Monthly payments, 360. So once it's done, then you're done. Then typically the interest rate on that one is a little bit more than a 15-year mortgage. You can also have a 15-year mortgage, meaning to say that it's amortized for over 15 years. So you pay it off sooner. The interest rate is actually lower on a 15-year than a 30-year. But because the term is shorter, the payment usually is a little higher. Okay, so most mortgages right now are basically based on a 30-year term. Okay, so there's also the what you call the ARM or the adjustable rate mortgage. Basically, it has the components of an adjustable rate mortgage. There is an index and a margin. Okay. What is an index? The LIBOR or the London Interbank Offered Rates, S&P 500, those are indices created by the market. And there is the margin. It's set by the bank. Let's say prime rate right now is at maybe 3%. We have a margin, that's the profit margin for the bank, it's set at, let's say, 2%. The index changes on a monthly or even on a yearly basis. So whatever the index is, you add that to the margin, that's going to be your interest rate for that period of time, whether it's for a year or 6 months or for 5 years. When the index changes, then of course your total interest rate charged on your loan also changes because the margin stays the same, the index changes. Most adjustable rate mortgages are actually just based or used by those who are a little bit more savvy in the market because they're not going to be using or keeping the property for a long time. Usually it's just for 1 or 2 years or 3 years, then they sell the property and then they move on. So they get an adjustable rate mortgage simply because the payment is what? It's a lot lower in the beginning, but over a period of time, it goes up because it adjusts. And that's just the nature of the adjustable rate mortgage. You have a very low start rate and then it keeps on creeping up on you. But for those folks who just want to have their first home even or just want to stay in the property for much longer, it's always more advisable to get a fixed rate mortgage. Any question? And so we were talking about earlier, components of a mortgage payment, principal, interest, taxes, and insurance. Okay. Here are now the credit basics. So this is where a lot of people actually are interested in finding out how do you find out what's my credit, how can I fix my credit. But by doing that, let's understand first the components of our credit score, okay? So what is a credit score? Or what is a credit report? It basically tells you, your loan, or the amount of money that you owe, who you owe it from, your payments, when did you actually start getting that credit? Okay, whether it's a credit card or a installment account, it will be on your credit report. The credit report will also tell you whether you have a collection account, tax liens, medical bills that have gone to collection, all sort of those things that have gone wayside. So here's a sample credit report right there. Information about you, your public record, collection agency account information, your credit history, and of course the inquiries. You can request for a free credit report from each of the 3 main credit bureaus annually at www.annualcreditreport.com. So you don't have to pay anything in order to get a copy of your credit report. You can only do that once a year though. If you want to get a copy of your credit report, go to that website, www.annualcreditreport.com, so you can get a copy of your credit report from each of the 3 different bureaus. What are those 3 bureaus anyway? Anybody know?